We are here to share our investment ideology and key learnings from the Masterclass with Super Investors book, focusing on Ramesh the Money Sir and Vijay KEDIA sir. However, please note the following: we are not SEBI registered investment advisors. This video is for educational purposes only. Consult your investment advisor before making any investment decision. The information shared is based on the book and our personal views, but we may be mistaken. Do not take it as a guarantee. Investing carries risk, so conduct your own research and exercise caution. We are not liable for any financial losses. Stay informed and seek professional advice. Let's explore the insights of Ramesh the Money Sir and Vijay KEDIA sir.
Our focus today is on a prominent investor hailing all the way from Kolkata, Mr. Vijay Kedia. Being born in a family of stockbrokers, their early exposure to the market nurtured their passion for investing. But unfortunately, at a young age of 14, their father passed away. But their grandfather acted as a guide of light in their life. Even during their school days, Mr. Kedia's grandfather took him to the Kolkata Stock Exchange, which then proved to be the reason for their fondness of the markets, which led to Mr. Kedia being the member of the stock exchange at an astonishingly young age of 18, surpassing the age limit of 21. Their tendency of getting into huge position and taking risk which some investor wouldn't even think about has become their hallmark of their career.
Vijay sir firmly believed that survival is the first rule of stock market. To him, the key is not just making money, but ensuring that he can withstand the ups and downs of the market. Let's shift our focus to Vijay sir's educational background. He holds a bachelor's degree from the University of Calcutta, which provided him with a strong academic foundation. Vijay Kedia sir's expertise and insights have earned him recognition as a market master. He has been invited as a keynote speaker at esteemed institutions like IIM Ahmedabad, IIM Bangalore, MDI Murshidabad, and even the London Business School. He has also been a TEDx speaker twice, sharing his wisdom with a wider audience.
Vijay KEDIA's remarkable career, successful stock pick, and education achievement undoubtedly has a significant impact in the world of investing. His focus is on risk management and several other aspects, but shows the key learning to all of us. Thank you for joining as we explore to the Vijay KEDIA's incredible journey. Stay tuned for the more insight and discussion as we begin with our masterclass with the Superior Investors series.
Here, I will walk you through the background and will extract some wonderful learnings from their initial days in equity markets, and then Shreyansh will take over to walk you through those case studies. So after making you guys aware and familiar with the personality of Vijay Kedia sir, let me just walk you more through the background of Vijay Kedia sir. For that, let me just share my screen. Hope you guys are able to see my screen. Right. So more on background of Vijay Kedia sir. Over here, we will discuss about the kickstart towards the share market. Basically, the initial days in the share market. How was their experience in initial uh, trading markets and all? Because they were basically more onto the trading in their initial days, then they move on towards investing. So first of all, we will discuss the aspects and a few of the key learnings and their background, their initial days, and all of that is related to trading, and then we will move on further towards investing part, right? So here trading basically, those who are not familiar with the word trading, let me just give you a gist of what the trading actually means. Is trading actually means buying and selling of any of the securities like bonds, shares, commodities, stocks, just to make profit out of it for a short period of time. Let's say a stock is at 100 and you assume that it will go up to 150 within 1 week. You just buy the stock for 1 week, and as soon as it gets to reaches the height of 150, you sell it. There are various other aspects of trading where you do intraday trading, where your position gets closed within a day. Then there is a platform called futures and options, where you buy futures of the particular Nifty index or stock. Right now, we are not more on to discussing trading part, but let's just focus on the learnings and what were the experience of KDSers during the initial days in that trading, right? So I hope you guys have got the gist of the trading where you buy stocks and other underlying securities just for short term to make profits, right? So let me just walk you through few of their experiences in their initial days in the share market. So in the initial days, they basically prefer trading and they made a few of their successful trades and they were highly successful in their early years, right? Now, when they are attributing their trading success, they attribute their trading success as beginner's luck because beginners luck why because most of the trades were based on their intuition, based on their gut feeling. You can say that basically whatever they feel, they used to do that. Whichever position they would like to take, they would take that, right? So there are let me just give you a gist of two kinds of position in trading. uh, People do say that we are long on such stock or we are short on such stocks, right? So long basically means you are bullish on that stock, you want to buy that stock, and you feel that the underlying securities or the stock will go up. And short on stock basically means that you predict that the stock will fall, and you assume that within a particular period of time this stock will fall and you will make money by that. We will walk you through few of the aspects of the trading in the later part, but let me just give you their experiences in the initial days. Right. So they attribute their initial days success as a beginner's luck because most of the trades were based on the intuition. They recall the some of their experiences where they have don't have any knowledge about the stock, they don't have any knowledge about what are the factors leading to that underlying securities, but just they were liking trading and they wanted to make money through trading. They started doing trading, right? And they made success also. Later they started increasing their position size. Of course, once you start, you start basically from small amount of shares and you try to just learn from the market and then you go on to big bets, right? So in likewise here also Vijay Kedias are starting with 100 shares, then they gradually move on to 200 shares of trading, and likewise they move on to increase their position size, right? So they refer to one of the trades where they have traded 5 lakh shares of Hindustan Motors, and they had made a good amount of money. So this was the concept where they increased the position size, and we should also learn from that. That initially, once we are starting something, we should start from small amount and we should start learning something, and then we will move on forward, increasing our position, right? Now, the next point over here is reinvesting the profits. Basically, reinvesting the profits is whichever the profits they have made in the earlier trades, they wanted to reinvest their profits to take more large bets and to get richer more faster. Now, I can connect this point with the value investing point where you can reinvest profit refers to stay invested in the market. If you want to learn more about this, you can watch our previous video of Ramesh Damani sir, in which I have explained through the example of investment in BEL and BEML that how through compounding in a value investing you can actually accumulate wealth. Basically, compounding effects happens only when you stay invested in the market. That is when you reinvest your profit with is you earn interest on interest, right? And that's basically the concept of compounding. So here in trading there is no such things like compounding because you take bets for small time period, and here reinvesting profit refers to is whichever profits you have realized earlier, you take more large bets through those profits and you will be able to accumulate more amount of money and you will get richer over faster. Means you will get more rich and you will become rich faster through reinvesting your profits, right? And in value investing, when you stay invested in the market, you will have a good amount of compounding effect on your money, and you will be able to accumulate a good amount of wealth through it, right? So you can watch it in our previous lecture of Ramesh Damani sir. He is also a veteran investor, and his ideologies are also discussed over there. You must be thinking that why I am walking through this background and why I am letting you understand through their investments and all, because this is the pretty good strategy through which you will learn the key learnings from such good and veteran investors. Uh, with their mistakes also and with their experience also, we will also be able to inculcate those ideas in our learnings of equity market, right? Now, when we move further, they had a habit of exploring things and exploring other businesses. So for that, to earn daily income, they started supplying materials to the tea gardens and jute. And they also tried different things because they said in the interview in this masterclass book that they love to explore things and they love to earn through various things, right? So that's pretty good. We could connect it over here that they initially do trading, then they also started investing. We will walk you through their investments and we will walk you through what are the key learnings and ideologies of it. Okay, so let's move on forward. The next point is willingness to try different. As we said, they explore businesses. They had a willingness to try different. They have the curiosity to know what are the things going on, and that why basically they also do trading. Also, they also started investing. Also, so they basically can be known as a value investor. Also they started. They were trading in their initial days, right? Because here what they believe is as you try new and new different things, there are more chances of success. You will able to earn, you will be able to create more other income sources and all. And if they believe that there are high chances of success, your chances of success increases. And you learn many of the experiences you learn uh, through your experience by, and there is a different types of learning from all the kinds of things which you do, right? So that was the basically their mindset to try different things and willingness to try different things, right? Now, the next path is towards lack of awareness. Lack of awareness basically they refers to what here is that back in the days, in the earlier time, there was not much of the awareness of creating a portfolio and managing a portfolio. Portfolio basically refers to your investments in various securities to accumulate wealth also and to achieve your financial goals and all, right? So let me just give you a brief of what is a portfolio. Like you have a portfolio of where you also invest in equity, you invest in debts, you invest in mutual funds, and there are various other financial goals where you want to buy a car also, where you want to buy a house also. So there are various other plannings and you manage a overall portfolio of various stocks and various securities, right? So there were lack of awareness during those days for managing portfolio and all. And many people were also unfamiliar with the yearly reports. Yearly report means the annual reports, the financial statements, the balance sheet, income statements, cash flow statements, which are provided by the company on a yearly basis uh, during the financial year, at the end of the financial year. You're right. Nowadays, though, you can access through various other research reports by the various other research firms. There are also portfolio management firms which manage portfolios of thousands and lakhs of crore rupees, right? So back in the days, there were lack of awareness regarding such kinds of things. So basically, they are referring to their initial experiences in the stock market, right? So the next point over here is uncommon knowledge. Uncommon knowledge is basically they are referring to lack of awareness regarding annual reports. And during those days, in Kolkata ring, there are BSC where earlier back in the days, there were used to trading by the the trading and bidding was done in the ring where uh, so the next point over here is uncommon knowledge. Uncommon knowledge is basically they are referring to lack of awareness only, where there was lack of awareness regarding annual report. So KDIs are occasionally do carry an annual report to the Kolkata ring. So people were giving surprising reactions to them, and they were shocked. And they feel that if a person is carrying an annual report to Kolkata, any of the ring, any of the trading ring, people feel that this person is highly educated. This must have done much more of the analysis on today's trading sessions and all. Basically, ring over here is earlier back in the days, trading and all was done in a ring where jobbers used to tell the quote with their hand reactions by saying that how much quantity they want to. They say this, they do such kinds of handy of the expressions, uh, gestures they do to tell the quantity of the quote and all. But today nowadays, all we have gone to DMAT and also this ring kind of thing has stopped now. So back in the days when in trading ring, when Vijay KEDIA sir used to carry annual report, people were felt that this guy is highly educated and all. And nowadays getting access to annual report is so easy. You can easily get access to annual reports because back in those days, technology was also not that much upgraded, so it was not easy to get access to all those annual reports easily. They were used to in scanned, or there were also annual reports in the form of booklet. So those were the days, right? During they are referring to those initial days. And now to there are various research reports, and you can easily access to annual reports and all. And for analysis perspective, annual report is like the base of the analysis. This is the must thing that which you need to analyze if you want to analyze a company or a stock, right? So this was the pretty good understanding regarding what were the background and what was the initial days trading sessions and all, whatever they have learned, what were their strategies and all. Now we will move forward towards what they have referring to trading, what were their bets and what the mistakes they did, what were their key learnings. We will move on to that, right? So now let's move on further towards understanding the trading and the concept of trading, the concept of stop loss, key learnings from that, whatever the KDS suggests, try to portray us, and we will try our best to deliver you and help you understand about the trading and stop loss concept, right? So, going much more deeper into the trading and concept of stop loss. So, before understanding the concept of stop loss, let me just give you a basics of the trading, and let me just help you understanding what are the base of trading, right? So, earlier while discussing the backgrounds and early and initial days of KDA, sir, I just give you a gist that trading is basically playing in the short-term fluctuations of any underlying securities like stocks, bonds, commodities, and all, right? So, to go more deeper into trading, let me just give you a difference between a fundamentalist and a trader, right? So, what a fundamentalist actually is, fundamentalists are the value investors, like what general investors do, that they basically invest certain amount of money in a particular stock and they let that wealth get accumulated as soon as the stock grows. And basically fundamentalists are for long term investments. Value investing is for long term investments, right? So what fundamentalists do is, like if the stock goes from 500 to 2500, basically here I have taken the example of fortnightly, that this is the in a month. Let's say this is Monday and the stock price is 500. This is the Monday of the next week and this is Friday. In India, basically markets work from Monday to Friday, and Saturday, Sunday, the markets are closed. So that's why I have taken the example. And the stock went from 500 to 2500. Yeah, I understand that fundamentalists and value investors do invest for long term, but just give you an understanding and the difference between value investors and traders. I am taking such examples where here this is the time frame of 15 days, right? So, excluding those 2 days, Saturday, Sundays of where the market is closed. So, when a stock goes from 500 to 2500, this is pretty good, 5x money, right? So, you earn 2000 of the profits over here. Yeah, this is basically the good concept of fundamentalists and what an actual investors do. So, basically, if a stock is of 500, so basically they invest 1 lakh rupees, and after 15 days, that if the stock becomes 5x, it went to 5 lakh rupees. So, if they want to encash and realize their profits, they will basically sold their portfolio of 5 lakh, and they will realize their 5 lakh of the amount, and basically the profit is of 4 lakh, right? 5 lakh minus 1 lakh. So this is the pretty good concept of fundamentalist. Just to explain you a difference between traders and fundamentalists, I have kept the time frame of 15 years because value investors do invest for a long period of time and let their wealth grow over the period of time, right? So moving on towards traders. Traders basically play between the fluctuations happening in this 15 days, right? So traders basically are the one who are timing the market. If you are trading, you are assumed to be timing the market, and if you are fundamentalist, you are not supposed to timing the market. And basically you analyze the company, you look at the fundamentals, you look at the financial reports and whatnot in the fundamental investing, right? So we will also cover more of the fundamental investments done by KDR sir further. And if you want to learn more about Ramesh Damani sir and their value investing learnings, you can watch our previous videos, and you can learn through that, where we have also discussed the key learnings, their recommending of the readings and all, right? So you can also watch that our previous video, right? So here we will discuss about trading. So basically, traders play in this between the fluctuations happening in this Monday to Friday, and then Friday from next Monday to Friday. So for a fundamentalist, basically what matters is if this stock went up. If the in fundamentals we prefer to, if you are long on, if you predict that the stock will go up and you invest. Basically, it's not predicting; it's basically full on analysis, and then you invest. So basically, you expect the company to grow. Over here, we will use the word grow. If you expect the company to grow from 500, the company grew, the stock company grew, the revenue increase and whatnot. The PAT is converting into cash, the cash conversion cycle and whatnot matters in fundamentals. And the company grew, and that's why the stock price also grew, right? Now, in trading, no matter what are the fundamentals of the business, no matter what are the underlying balance, what is the underlying list of the balance sheet, and what is the PAT and what is the revenue, right? Doesn't matter for any of the traders. Traders not basically open a single annual report to analyze a company. They basically trade on the price chart, right? So they're on looking onto the price chart. Now, how can you say if a person is bullish? No, here we won't say bullish. They are having a long position. If they predict, we will use here word predict, that the stock will grow, and they will be having a long position. Long position is basically bullish, that the stock will grow, and short position is basically you are assuming that this stock will fail. So if your prediction goes right, you will earn money. So this is the pretty good concept of trading. What here we refers to is that some people also trade for few days, some people trade for a day also, that is intraday. We will discuss a gist of such kinds of trading patterns, and then we will move on forward, right? So here in trading, fundamentally what says the stock is over at 500, then it went to 2500. But for what trader, what matters is the fluctuations happening between this 500 to 2500. This is 500 and this is 2000. Between this, the stock had moved up, down. Then it has been, it could be a stagnant growth, and then it has moved up and down, up and down, up, and then it has reached this 2500 of the value, right? So here I have just to give you an understanding. This is the dummy numbers price chart, that how that stock went from 2000, it fell to 450, then 400, then it grew by 700, then again it fell, move on to 12,000, 1200, 550, then it again fell to 1000. So this is the fluctuations, and here they bet. Let me just give you an understanding. Let's assume that on Monday the opening price of the stock was 500, and on Tuesday it went to 450. So those who are playing intraday is basically playing on a daily basis, that you predict that today the stock will go up or today the stock will go down. So basically, if you predict the stock will go up, you are long. We have discussed this earlier. And if you predict that the stock will go down, you are short on it, right? So here in trading, they play over here in the fluctuations, right? So if you predict that the stock will fall, and assuming that here, if your predictions went well, you will earn 50 rupees. It matters on the how what is the quantity of the bet, right? Trading happens in the quantity of the bet and whatnot and all. We are not moving much deeper into it. I am here to just give you a basic understanding, and then we will move on further towards understanding the stop loss and what are the key learnings of the trading. So those who are keen to understand more about trading, they can have a gist and they can have a kickstart from here, that what is trading and all, right? So if a trader is short on it, he will make money, he or she will make money. Now on Tuesday again the stock was at 450. Now those who have the long position, those who predict on Tuesday that the from 450 the stock will again rise up to 500 and all, and it will went to 550 and all, they would have lost money, because the stock on Tuesday, Wednesday becomes 400. That is at the end of the day, Tuesday, it becomes 400, right? So opening price on the Wednesday becomes 400. That is those who have the short position, they would have make money. On Wednesday, again, you bet. If now here the stock price on Thursday, we know that for the price chart, that stock went from 400 to 700. That is the profit of 300 rupees, right? So if someone is a trader is long on it, they would have made money. So if they are long, if a trader is long and if he is predicting that the stock will go up and he has a long position in that trade, he will make money in the intraday. Or else someone can play for a few days as well. That if today it's 500 and then it predicts that the stock will grow within 3 to 4 days. So it holds the position for 4 days and you make money. So here the stock grew by it was 500 and here it grew by 200 rupees, right? So you made a profit of rupees 200 and you encash your profits, and that's all, which is very much a contrasting situation to fundamentalist, right? Fundamentalist invest for longer period of time. So this was the pretty good concept and the base of the trading, which I wanted to give you so that you can able to understand what is the stop loss. Stop loss is one of the factor to protect your trade and to minimize your loss. Which will help you to prevent and make not much of the loss. So let's get much more deeper into the stop. So now let's move on towards understanding more further about stop loss. So let me just give you a theoretical understanding of the stop loss. An order placed to automatically sell a security at a specific price aimed at limiting the potential losses. You know, losses are not defined. Your predictions may go wrong. Your predictions may go right as well. We can assume that there are chances like heads and tails. Whether you toss, you may get right. If your call is head, you may get right or you may get wrong, right? It's basically that's pretty simple. So let me just annotate for your better understanding. Yeah. So order placed automatically to sell, automatically sell. Now how it gets automatically sell? Let me just give you an proper understanding using this case study, right? So assuming that the Nifty index, this is the case one. So assuming the Nifty is at 6,000 points, right? And you expect your prediction is that the market will fall and will the value of the index will be 5,500. So basically you had a short position, right? You are short on Nifty, you predict and you assume that the Nifty will fall, and you say Nifty futures or you buy the quantity of 50, right? So you put the stop loss of 6,010. Now, what is 6,010 basically stop losses over here? There are two kinds of stop loss over here. They are not named basically. So if you're having a short position, understand properly that if you have a short position, when you will make money, when your predictions get right. What are your predictions? That the market will or the stock or a Nifty will fall. If Nifty falls and your prediction gets right and you expect that it will fall till 5,500, you will make money. When you will not make money, if from 6,000 if it goes to 6,001, 6,002, 6,003 and likewise. Okay. So if it gets increased by 1 point, 2.3 points, you will lose money because your prediction was the market will fall, and if market rises, you will lose money. So that point where you will lose money, you put a stop loss behind that point. Beyond that point, that beyond this point, stop loss is basically that point that beyond this point you cannot bear losses. This is the minimum amount of loss which you can bear, and minimum amount of fluctuations which you can expect that the stock will fluctuate over here, right? So the stop loss of 6,010 is market will fall. You assume that market will fall and your position is short. And 6,010 here refers to if the market increased by 10 points, your position will automatically get closed and you will not make further losses by 10 points, right? So till 6,010, you made a loss of 10 points, assuming talking in terms of points because you will able to understand properly, right? So 10 points. Now you cannot bet further that it will rise or fall. So your position will get automatically closed at a loss of 10 and you will not make further losses. So automatically, right? You don't need to be watch your screen and you don't need to punch manually that now cut my position. At the time of trade only, you put the stop loss amount, assuming the fluctuations in the market. We will come to this that what are the ideal methods to put stop loss in a short. Because this will directly connect with the mistakes done by Vijay Kedia sir and what are their learnings from stop loss. At that time, we will tell you that what are the right methods to put stop loss. But before that, I want to just give you a gist and understanding of the stop loss, right? So you are short on the market. If the market rises, you will lose money. That's why you put the stop loss of 6,010, right? I hope you guys have understood what I want to convey, right? So here the stop loss is 6,010, indicates you are short on Nifty. To protect your loss, that is your major losses, it will automatically cut the position at 6,010, right? You can go right. If the market falls, you will make money. Just to protect yourself, just to cut your losses, you put stop loss. I hope you guys understood the pretty good concept of the stop loss. Let's get more deeper into the understanding of stop loss. So here KEDIA refers to a statement that you lose once or twice, but then you start getting it right. you again gain confidence and keep pricing your positions. Remember in the background, while discussing, we were discussing background of Vijay Kedia, sir. He has referred to increase in their position size. That's the concept we will link over here, right? So you lose once or twice. It may be that your predictions may go wrong. As I said, Kedia sir started with a zero level of the knowledge in trading. They just were keen to learn trading. They wanted to make money. That's for the reason that they started doing trading, right? So that's what sir is saying, that you lose once or twice. Then you will try to understand. Maybe your predictions may go wrong, and in spite of falling, the stock rises, right? So just at that point of time, you basically study where you lose money, where your predictions went wrong. Then again you start, again you take another position, right? Assuming the same position, 6,000, nifty at 6,000, and it will fall to 5,500 and all. Again you are short on position, again the stock went up and you lose. So once or twice you will go through the price chart and all. We are not discussing over the patterns and all, but I'm just giving you an understanding that once or twice you will feel that where I went wrong, and you will be keen to understand from your experiences. But then you will start getting it right. You will start putting your stop loss rightly. That yes, you had a strong conviction over here that the stock will fall, and then you put stop loss, and then you start getting it right. Yes, the stock falls and falls, and you make money, right? So here in case two, let's assume that the stock falls. The fluctuations, considering the fluctuations, the stock fall to 5,950. That is fall by 50 points, right? Now you are excited. On your trading state, you will see that whatever the amount you had invested is rising, right? So you need to take much more positions. Like, okay, I hope you are understanding. So keep increasing your position is, now you are getting keen to earn more profits, right? Sir said that to become rich faster, I used to keep reinvest my profits. So whether let's assume that you earlier made profits and you again want to invest. So you earlier you had a quantity of 50, because just you wanted to know that whether your predictions are going right or wrong. Yes, it went right. It falls by 50 points. You again expect that it will fall by 5,500, fall to 5,500 points. You're again short on it, and your quantity is 650, and your stop loss was 6,010. Now the nifty falls to it again. You are at 50 at 50 quantity, then it falls to 5,970. Expectations are 5,500. You are short on it. Now you feel like, yes, I will make money, the market is falling, and you started increasing your position. You bet again on another 50 stocks, 50 quantity, right, of the nifty or any particular stock. You are had a strong conviction that this will fall. To increase your position, so what your position becomes is 100. So now you are holding nifty stocks, nifty index, futures, or any of that 100 quantities, right? Stop loss again is same, because you don't want to lose money, right? Now in the case 3, the market fall by 70 points more further. It was here at 6,000. It falls and falls, and then it comes to falls by 100 points and becomes 5,900. So now you again get excited and you wanted to make more money. And then again, you increase your position by 100. Now you are increasing your position by 100. You had a very strong conviction. You know that now the market will fall. There is no turning back. Market will fall, and you again invest more money, and you buy again 100 quantities. And this is how you keep increasing your position, as well as along with keep putting your stop loss, and you don't want to lose your money, right? So here, as more on the nifty falls, you start gaining your confidence. Your confidence rises. Yes, your ideology is going in right direction, and you feel that your values are getting right and all, and you increases your position size, right? Now you must be in the dilemma that what happens to stop loss if your predictions get right, right? Nothing happens. You don't have to invest any money to put that stop loss. It is just basically a position where you want to close to limit your losses, right? So if your predictions get right, nothing happens to this stop loss. It stays up till you exit your positions manually, right? So this was the pretty good. So now let's move on further towards understanding that what's actually the importance of stop loss. You had a great conference. You know that you will definitely go right on your predictions and all. So what is actually the importance of stop loss? You don't want to put stop loss and all. Understand. Let me just help you go through with the example that when considering, and you need to cut your losses some of the times. Now, what is I am referring to cutting your losses? What traders should consider? Traders should consider the illusion of the recovery, momentum, and stop loss orders. You should take into the consideration the importance of stop loss, momentum. That is basically the fluctuations in the prices. Yes, fluctuations in the prices and illusion of recovery. What is a basically illusion of recovery is? Uh, Let me just help you with the example so you will understand that what's actually I'm referring to illusion of recovery, right? So cutting your losses promptly is essential, but it requires discipline. Now, what actually is cutting your losses? Cutting your losses is directly related to illusion of recovery. Assume here that the stock price is 1500, right? So the stock price is 1500 and you had a long position. You feel that the stock will go up here from 1000, sorry, 15K. It will rise to 2500 and 3000 and all, right? 2500. Let's assume that within few days it will went to 2000 or 2500. So, but it could happen that your convictions may go wrong, and assume that you haven't put the stop loss order, right? And you go fail on considering the momentum in the stocks, and the stock price fell to 1000. Now here, uh, assuming that you had bought the 100 quantities of that stock or the lot of index futures and all, your the price fall by 500, right? And multiplying it directly by the quantity, that is 100, it come give you the 5000 50,000 of the loss. Sorry, my bad. It's 50,000 of the loss. So you, now this 50,000 is the notional loss. Notional loss basically is unrealized loss or paper loss, paper profit, paper loss, right? It's you have not cut your losses, or you have not exited your position, right? You have not canceled the trade, that is exited your trade. So when you exit your trade, it basically becomes your realized loss. Basically, realized loss is uh, the loss is directly deducted from your investment amount, right? So if you had invested 1 lakh and you get a notional loss of 50,000, it's the basically paper that is you this loss you will be able to see on your trading terminal that your position is cut down by 50,000, right? This is notional loss. But when you exit your position, it becomes definite loss. This is basically cutting your losses, cutting your positions to actually realize your profit or loss, right? Now, what happens is there is an illusion of recovery comes over here. When the stock fell by 500 rupees from 1500 to 1000, you again gain your confidence. Let's say on trading terminal you are able to see 50,000 of your loss, and you again gain your confidence, and you assuming that no, from here there is no looking back, the stock will revert back, and from 1K, that is 1000, it will again rise to 1500, then it will go on to 2000. Remember, the stock fell by 50, that is 500 rupees. Your loss was 50,000. Assuming notional loss, you haven't cut your positions right now, right? You haven't cut your positions. This is the notional loss, right? So you have a notional loss of 50,000. Remember, to make profits, first you need to recover this loss, then you will be able to make profit. And there is illusion of recovery that market will revert back, the stock will go up, and then you will able to create profit. But that's not always the case, right? When market hits a particular stock or an index, it may be that it's hitting consistently and it's falling down for that day or for the particular period which you have selected, and the stock is falling down and falling down. It may happen like that, and where that's where your illusion of recovery goes wrong. You went wrong on your predictions, you went wrong, and that's where the 99% of the time traders went wrong. And that's what KDA sir is referring to, is that if you don't cut your losses, then 99% of the time this loss of 50,000 will go to 2 lakh and all, and that's basically where you may lose more of the money than 50,000, right? So now tell me whether the 50,000 of the loss was acceptable or 2 lakh of the loss, right? Obviously, if you had cut your positions at 50,000, you would have even get your at least half of your principal back, right? But losing almost 200%, 100%, as well as again another two, that is 200% of your principal is not the right thing, right? So if this stock falls from 1,000, it falls to, assuming that it falls to 750, right? It goes to 750. Again, it fell by 250 rupees. Multiplying it by directly by your quantity for which you have assumed that its stock will rise, that is 100. So you again made to 25,000 loss, right? So that is basically the concept of cutting your losses. That's where you require discipline in putting your stop loss. That's where you require discipline in understanding, gaining experiences by the time, and where to cut your losses, where to assume that there will be the period of recovery, and you not need to be in the illusion of recovery, illusion of the momentum, and you should not neglect the stop loss orders, right? So, guys, now let's move on towards understanding the mistakes done by KEDIA sir during the trading period, and whatever the key learnings from that trading, right? First of all, we will focus on the mistakes done by them. Then we will move on towards these key learnings. So you will be have a better understanding, and you will be able to recollect it and connect it with mistakes done by sir, right? So first of all, the understanding is random stop loss placement. Remember, earlier I talked about I will teach you that how the placements of stop loss will be done and all. So here is the time that I will explain you. I will just give you a brief understanding of it, and then we will move on forward. Right. So random stop loss placement is basically, now understand what people do mistake is, now I have explained you the concept of stop loss, right? So if you are short on it, you will your stop loss will be above the current market price of that. So you don't want to lose money, right? If you are long on it, you will put the stop loss below the current market price, as if the stock price will fall, you will lose money, right? So these are the random stop loss placement. Now you forget one of the most important factor over here is momentum in the stock, fluctuation in the stock. Without understanding the fluctuation in the stock, you won't be able to put stop loss, right? This was the major mistake done by sir during their trading period. And I think after learning from here, if you guys start, see, we are not any doing any recommendation, or we are not helping you to trade. We are just providing you an understanding of this, and these are the learnings from KEDIA sir's experiences, right? So initially they place stop loss randomly without considering the volatility of the stock, and this is the major mistakes done by premature traders and all. You need to identify the opportunities for the profit, and then you need to understand the fluctuations, and then you need to start doing trade, right? So what I'm talking about, right? You must be thinking, what are the fluctuations I'm helping you? Let's just go through dummy numbers, then we will help you understand this, right? So I hope you guys are able to see my Excel sheet, right? So understand the stock current market prices. uh, yeah, price is 100, right? Now whenever you see the volatility in the market, it's basically, we are familiar to the concept upper circuit, lower circuit, right? So 5%, if the stock grows, any of the stock grows by 5%, that means there are more of the buyers. So at that point of time, SEBI stops trading of that stock, right? So considering that there is 3% of the volatility, right? So 3% of the volatility means this stock, this particular stock, let me just annotate it for your betterment, right? So this 100 rupee of the stock can, within a trading period of 9 to 3 trading time, it could go 3% up also, it could go 3% down also, right? So 3% up is, if the stock is at 100, the upper part, considering the volatility is 3%, the highest it could go is 103. This is just a consideration, right? Consideration of the volatility, it could not be the highest, but considering the volatility. And the low it could go is 97. Now if you are long on stock and you are considering that the stock will grow, that the stock prices will grow, and here you are at 100, and you want to make money, and your expectations are that you are long on it and you are bullish on it, right? And you put a stop loss that you are very very scared of losing your money, right? So what you do is, you put stop loss of 99. How much is the difference? Only 1 rupee. Now, considering the volatility in the market, 97 is the like minimum you can say that the stock can be fluctuate. So if you put a trader over on the stock broking site or any other, that 99 is your stop loss, your trade will automatically get cancelled when the price is fluctuating between this period. Assuming that you are bullish, let's say that stock price is 100 and it went to 110. Here it went to 97, 96, right? And here is the price of 99. Now, when the stock will come to 99, your trade will get cancelled over there. Now, what was the benefit of putting the stop loss of 99? The stock has momentum of 3%. Minimum, it could go 3%, right? Maximum, it could be any, but considering the minimum volatility in the market. So, you need to understand the volatility that is over there in the market. And now we will consider that let's take an example of that consider a minimum volatility as per your convenience that you take 3%. No, you need to study the price chart and all. Now, here we are not there to deliver you the trading session. We are just giving you a gist and understanding that we could connect with KEDIA's learnings, right? So, stop loss of 97 is not okay, right? You need to put at least the considering the volatility 97. So, 97 is the volatility. It could go the lowest till 97 minimum. So you could put that 94 or 93, right? 94, 92, 93. That's pretty much conservative point. Okay, that you don't want to lose 6 rupee per share or 8 rupee per share, right? This is the minimum you can bear. And that's pretty good concept where you need to understand the volatility in the market. Otherwise, you won't be able to understand the stop loss concept, right? If I show you the Nifty price chart, no, you will be able to understand it. So let me just clear all my things and let's move towards the presentation. I have another example for you over there. Look, over here, you can see that I have taken an example of suppose both Tata Motors and Tata Steel are trading at 500, right? Both have same price. Now here Tata Motors I have just taken for you to understanding. I'm not saying that they are trading at 500, just hypothetical example, right? So understand that Tata Motors and Tata Steel both are subsidiaries of Tata, right? We could say that this is Tata Motors and this is Tata Steel owned by Tata. Considering that this is 500, now most of the people have the mindset that they are owned by Tata. So basically, they would have same fundamentals, and no, they are different businesses. This is the point where investors like Kenneth Andrade sir and other in value investing, they have played cycles, right? And this is the motors, this is the automobile sector, and this is completely different. This is steel sector, right? So steel industry. So you can't assume the fluctuations in the stock price to be same. Tata Steel would have less volatility as it plays cycles and there are cycles going on. It would have less volatility, and Tata Motors would have more volatility. So putting stop loss of rupees 10 is understandable, right? It's comfortable that you can't lose more money than 10 because it's less volatile, right? Also, you can because the stock price is also 500. So 490 is the minimum loss you can is the minimum price which you can accept of this stock. But now considering for Tata Motors, if you put 10 stop loss as 10 and you're bullish on it, your trade will get cancelled when it comes to 490 because considering the volatility in per day, the stock per day or any your time period, the stock is has the volatility of 10% or so, right? So you need to put stop loss of at least 40 to understand. These are just hypothetical example considering more volatility. You need to put stop loss more than the Tata Steel. This is just basically a pretty good understanding. I am not referring to a particular company. Even I am not showing you the particular price chart, current market price. This is just an hypothetical.
Now let's move on towards next mistakes, that lack of understanding in stop loss. This was the mistake done by the Vijay KEDIA sir, that they put stop loss without considering the volatility in the market, volatility of the stock, right? Now learn from here that you need to consider volatility in the stocks while you are trading. Remember, stop loss has no 0% connection with the fundamental and value investing. This is just a pretty good concept, which is very important and connecting to trading, right? So lack of understanding in stop loss. They weren't able to understand that how to put stop loss properly unless and until they were advised by someone that you need to put stop loss in this manner based on the volatility of each asset. Each asset means no Tata Motor has similar volatility and Tata Steel, right? Each and every asset has different volatility in itself, right? So you need to understand this. I hope you guys have learned from here something and you won't repeat it again, right? We are not, yes, this is not a trading session, but yes, in life also we should not repeat the mistakes which we have done. Do mistakes, mistakes are to be done. We are human beings, but yes, do never repeat those mistakes, right?
The next point is unrealistic expectations, right? So, unrealistic expectation is the, again the volatility point, right? The stock can go up also, the stock can go down also. Now, it could be that sometimes your predictions may go wrong, and what we have understand earlier is the same concept that maintaining losing position doesn't guarantee recovery. Losing position is, you are long on some of the assets, a particular stock, and it's falling down, right? So you are expecting that the stock will recover, your loss will minimize. You need to understand from your experiences, and you need to study the price charts for that. What we earlier discussed here is in the concept of notional loss. Here, notional loss is 50,000. I hope you guys have understood and you won't repeat such kinds of mistakes. So these are the mistakes which are done by KEDIA sir. Maintaining losing positions, your paper loss is there and you won't cut your positions. You may end up losing more money than what's actually now, right? So the loss should be minimized based on your expectations, based on your learnings. Let me just show you Nifty volatility, right? You will able to understand what I'm trying to refer to. You can see this is the 5-day chart of Nifty current. So you can see the volatility. It went over here, then it went down, it went it again. Let me just clear all my drawings, right? So you can see over here that it started from 18 to 50, then it again fall, it can fall to again 18 to 100, right? So here you can consider the volatility. You can see that it ranges from, in 5 days, the Nifty ranges from 18,200 to 18,500, 300 points, right? Now, considering the 300 points of volatility, if you are buying any futures and if you are bullish on it, long on it, and you just put a stop loss at 18 200, let's say 10 points below, right? So how, considering 300 points of volatility in this, how can you put just stop loss below 10 points, right? 1800 and 190 of the stop loss, it's not okay for it. So I hope you guys have understood this concept, right? These kinds of mistakes were done by KDS sir, and they may cost huge, right? KDS sir refers to one of their instances where their mother had to sell their home gold which was stored in their home to recoup those losses made by KDS sir in trading. So be serious with such kinds of understanding and learnings. Okay. Now let's move on towards the key learnings, that are the most important aspects, that what actually we learned and what actually KDS sir want us to portray from their learnings in the trading field, right? First of all, and you will be also have an intuition that importance of the stop loss. Yes, I hope you guys have learned through this session that what's actually the importance of stop loss. Setting stop loss to reduce future losses is one of the most important lesson which we have learned, because it helps in risk management, and it also helps in preventing major financial failures, right? Trusting your intuition has helped the KDS in their initial stage where they didn't had learnings of the market and all. But as being a rational, I want to say that trusting your intuition works when nothing actually works for you and nothing actually helps you to understand what to do. At that point of time, your intuition actually helps you, because we had a thought and we had a quote that suno sabki karo apni, right? That kind of the thing. Not always in all circumstances. Yes, using intuition was useful in some circumstances where they had nothing. Nothing here refers to no learnings, no understanding. You are not able to break down that crux. You are not able to help understanding your decisions. You are not able to come to a conclusion that what you need to do through this trade. So at that particular point of time, your intuition may help, right? So it helps you to handle certain difficult situations and made decision based on your instinct, right? Planning and strategy. Planning and strategy is again over here directly connected to the stop loss. Random stop loss will be very ineffective, right? Resulting in unforcing market exits. Matlab, means you will be able to exit your trade without being known, right? You will be in a dilemma where you are happy about your trade, you will make good money, stock is going up, but where at the initial point of time where let's say your stock goes down and your position gets cut and you are in the dilemma that yeah, you are enjoying the profits, but it actually doesn't happen. You need to consider the volatility. I think we had a good discussion about that. Investors realize the necessity of developing and sticking well to the thought out of the trading strategy. You need to stick with your trading strategy. And where we learned about the mistakes, that unrealistic expectations, you need to understand that certain kind of situation may have arises in the history of the Nifty or any of that particular stock. So you need to study those price charts and all, and you need to take a call on based on those learnings and experiences, right? Now, here I want to just give you a quick note that we are not traders. We are not any market influencers. We are just providing you the learnings from Vijay Kedia sirs, and we do respect the confidential information, right? So this was the pretty good understanding and key learning from planning and strategy, right? The next understanding and learning is from survival in the market. Survival in the market basically refers to stay in the market. To you need to survive in the market. The two rule that the whole world follows, even Warren Buffett, uh, great investors, god of investors, right? They also follow the same rule. Rule number one: never lose your money. Money means the principle. If you follow such unrealistic expectations, right, market will fall and you are expecting the recovery and you don't have any understanding about that, that won't help. Never lose your money. First of all, to earn interest, you should have your principal safe, right? The principal should be safe, then only you will be able to make money, and then only over there you will be able to make profits. So yes, the rule number one is really correct. With a tick mark, you need to follow across. That is, never lose money, right? And rule number two. Now, what is rule number two? Never forget rule number one. This is the two rule which whole world follows. And yes, I want you guys also to fit it in your mind for lifelong, that never lose money. And rule number two is always remember rule number one, right? So uh, the first rule into trade is to survive. Many traders compel to exit the market, emphasizing the significance of the risk management and capital preservation, right? So most of the time, what happens is the traders, when they suffer through once or twice the losses, they lose confidence and all. Basically, they are referring to that. You need to don't lose your self confidence, and you need to stay invested in your market and protect your principal. Then focus towards earning profits, right? So this is the pretty good concept, and this concept will also affects the trading. Also applies to fundamental investors both. This okay, guys. The next understanding and the learning is from time and basic expenses. Now, this is the most important and critical learning from Vijay Kedia sir, not only based on the trading, but also based on the fundamentals, and not only part of investing or trading, but also we should inculcate these learnings in our real life, that before taking bigger risks, it's critical to ensure that basic expenses are covered and certain level of financial stability is reached. We we are human beings and we are followed away by our emotions. When you are seeing market is rallying, or your trade is being successful, you get into the emotions, and by the flow of emotions you try to invest more of the principles, but it could go wrong also, as we have discussed a lot. So they refer to and they have stated that they, first of all, during back in the days, they keep aside that they understand that 10 to 20,000 of the rupees should be there to at least to have food, shelter, clothing, and all, right? Then you need to take bigger risks. So out of your investing, or let's say trading, your basis expenses are taken care of. Then you need to take larger bets. Then you can risk, because risking. There is a wonderful statement stated in Psychology of Money by Morgan Housel that never risk what you have, right, for earning what you do not have. This is a very good understanding because you are risking over here. What you have is you had 10,000 rupees. You can afford basic necessities, right? Then again, you are risking those in spite of having lack of knowledge and all. It's pretty good dicey, right? Because you may lose your certain expenses if you have uh, earned 10, 20,000 and you have kept that aside. Then you can move on towards earning more profits, right? And taking larger bet, taking bigger risk. So that was the pretty good concept of time and basic expenses. Time to time you need to remember because 10, 20,000 are not for lifetime in back in the days. Now so we require 30,000, right? Let's say these are the basic expenses which are required on a timely basis, not for one time they are. So you need to fit in your mind that first of all, your basic expenses and basic necessities are taken care of. Then you can go on towards taking the larger bets, right? Moving on towards our last learning. After inculcating all this learning, this comes. Why? Let me just walk you through. Courage and intelligence. Courage basically refers to taking a large risk and intelligence to make informed decisions. You need to take seen decisions. You need to be very clear with your understanding, very clear with your ideology before doing any trade or doing investing, right? So element of luck plays role. You know, there is also a quote by other investors that 90%, let's write here, 90% is your learning, understanding. 9% depends upon your other factors, external factors, and 1% plays the role of risk. You may be right at that 90 percentage, right? You may be right at those markets would be in your favor. Like market means other, not market, but other environmental factors would be in your favor, right? Other external factors. But 1% is the risk that play a role. It is the luck, sorry, luck that plays the role over here. This is the most important learning we should know that courage to take risk should be there. We understand from the concept of time and basic expenses. You need, in Hindi, people say you need jigra to take large bets, right? So that was the pretty good understanding from the key learnings and trading. I hope you guys have understood the concept of trading. Now let's move on towards a investment done by KEDIA sirs and let's learn from that case studies, right? So I hope the trading part you must have understood.
Now, let's move towards understanding key learnings and investing ideologies from investment done by Vijay Kedia sir. Let's understand Vijay Kedia sir's investment in Aegis Logistics Limited. Let me first give you overview of this company and then we will go towards these charts and table. So, Mr. Vijay Kedia sir had invested in Aegis Logistics, a company with market cap of 25 crores and sales of 80 crores. You can think that here sales of that company is more than double of market cap. Here there is zero possibility that he can lose his money. So it's a very good investment and at a very cheap valuation. With manufactured storage, which manufactured storage tanks for oil companies, but had recently diversified into making LPG dispensing stations. The company had planned to establish 125 dispensing stations. He saw potential in this expansion and decided to buy shares in the company. He started buying at rupees 15 per share and bought till rupees 50 to 60 rupees. He had bought some 8 lakh shares, around 5% of the company. So basically, he has found out this undervalued stock and also seen potential in this company as they are having good plans of expansion. initially he had already done buying 1% of this company, and then he wanted to buy 5%, but he had no courage. So he went to Rakesh Jhunjhunwala sir for advice, and he encouraged him to buy that 5% stake in a company, in that company, saying that if he wanted to do it, he should go ahead and do it. It's a very powerful statement. If you know that a company is going to be great and will perform very good in future, then you should increase your stake and go ahead with buying decision. The company was good and they had hired good people. Most importantly, the stock was cheap, but the stock initially did not show much movement and the company struggled to meet its projected business targets. They have decided to establish 125 dispensing stations, but are lagging behind that time. However, he remained patient, relying on his other properties in Mumbai. Over time, as the company's financial state results improved and numbers started to come in, people became interested in the stock. Its price surged to rupees 500 and he began selling some of his shares between rupees 300 to 500 range. However, the stock eventually fell to rupees 100, prompting him to buy back and buy back the shares. We can see that he has purchased at a rate of around 15 and bought till rupees 60, and then he sold some of his shares at around 300 to 500 level. And however, the stock eventually fell to rupees 100, prompting, and here he has bought more shares of this company, and the share price has went to around 920 rupees, and here he has sold at rupees 800. The company's market capitalization grew from rupees 25 crore to rupees 8,000 crores. That's very big, and his investment proved to be highly successful. We can see in this chart that the stock price went to rupees 15 to rupees 920, which is a multi-bagger stock. As we can see in this table also that its fundamentals has also improved with time. Net sales of around 2004 was around 81 crores. In 2005, it went to around 121 crore, which is 49% growth. In 2006, it's 115 crores. In 2007, it's 240 crores. And in 2008, it is 389 crores, which is a growth rate. We can see here the growth rate of 49% from 2004 to 2005. From 2005 to 2006, it's 28%. And it goes on. Profit after tax also increased in years from 9 to around 38 crores. Debt to equity ratio of this company has increased due to its expansion plans from 0.4, 0.4, 0.3 in 2006 to 0.7 in 2008. And we can see the growth in market cap, 26 crores in 2004 to 403 crores in 2008. And market is giving very good valuations from PE of 3 in 2004 to PE of 10 in 2008. That's a good sign. Now let's understand how to find these stock prices. How I had find these stock prices. For this, I had gone to BSE website. Let me show you. So we have came to BSE's page, Now I will write AG's capital, company's name, archives. For yearly data, I will find from, let's say, 2004. So here I will get all the data of opening price, high, high, highest in that year, lowest in that year, closing price. So this is how I had found and made the chart, stock chart. So let's come back to here. In this case study, we have basically seen four key learnings. First, Vijay Kedia sir has bought this company at a cheap valuation, which is one of the reasons why this investment proved to be highly successful. Second, his position in that company. He had 5% stake in that company, which is also one of the reasons why he is very successful. Third, the company was good and they had hired good people. That means management was filled with good people, which also plays a big role in making a company good and successful. Fourth, their expansion plans. Their expansion plans are the reason why people became interested in that stock. And these are also the reason why they have gained market cap from 25 crores to 8,000 crores. And which resulted in highly success in of that business. Let's understand the key learnings from another investment of Vijay Kedia sir, which is in Sarah Sanitary Ware. Let me give you company's overview and his investments overview. Mr. Vijay Kedia sir had invested in Sarah Sanitary Ware in 2004 to 5. It was cheap on PE basis. Sarah Sanitary Ware had 20% market share. It was growing at around 10 to 15% every year. He bought some 4 to 5 lakh shares at an average price of 35 rupees. There were only 3 to 4 organized sanitary ware companies in India, HSIN, and second Perriware, and third is Sarah Sanitary Ware. HSIN had a 40% market share in and Perriware had a 40% market share, and the remaining 20% share was of Sarah Sanitary Ware. Sarah was a totally neglected stock. Perriware sold their sanitary ware business at 3 times its sales, while Sarah was trading at 0.5 sales. It is a line which make us understand that it was a very cheap stock. Perriware has sold their sanitary ware business at three times sales. Let's understand this through numbers. Suppose the sales of Perriware was around 100 crores, and it sold its sanitary ware business at around 300 crores. Now, for Sarah Sanitary Ware, if Sarah was making a sales of 100 crores, and now it was trading at 0.5 times sales, which is around 50. Here also, in past, we have seen in case of Aegis Logistics that it was trading at 25 crore market cap and its sales was 80 crores. So there is no chance he will lose his money. Now let's get back to the case study. That clicked with him that there is value and a margin of safety in the business. At least he won't lose money. He asked a builder, cousin of him, that if he had heard of Sarah Sanitary Ware. He said most builder used Sarah as it was a cheaper brand. He saw it as a mass consumer brand. Then company started growing fast from 2010 onwards, and the stock went up to rupees 4,000 in 2017. We can see in this stock chart that he has purchased around in rupees 35 rupees, and the stock went to around 4,000 rupees. That's a multi-bagger stock. And we can see in the company financials and fundamentals that the net sales has increased from 128 crores in 2008 to around 1007 crores in 2017. Its profit after tax has also increased from 10 crores to around 100 crores, which is 10 times. Its debt to equity ratio has also came down, which is a good sign, from 0.7 to 0.2%, 0.2. Market cap has gone from 69 crores from in 2008 to around 3,919 crores in 2017. That's huge. So the key learnings from this Sarah Sanitary Ware are: first, Vijay Kedia sir has found Sarah Sanitary Ware and invested in it at a cheap valuation, which is very important part for an investment to be successful. Second, this industry is transferring from unorganized to organized, which is very important because it opens gates for more growth and also for more good opportunities to invest. Now, let's move towards understanding Vijay Kedia sir's investment strategy. Investment strategy. Vijay Kedia sir's strategy involves focusing on small cap companies that were leaders of the bull market. By focusing on small cap stocks, they found opportunities that moved after the large cap stocks had already made significant gains. It is basically, let's suppose there is a bull market in chemical sector. So firstly, large cap stocks will move first, then it comes mid cap stocks, and then it comes small cap stocks. This is the time where Vijay Kedia sir finds a good company which is lesser known and with a potential for significant growth. And this could be only be done by reading a lot. It is very important. Many investors have habit of reading regularly. So it is a very important habit. The trend of one sector consistently leading the bull market changed after 2003. Sectorial rotations continue to occur, indicating that many sectors had led the current bull market. It is important for investors to catch the sector trends to find great investment opportunities. So we can basically get ideas from this diagram that in mid 1980s, automobile there was a trend in automobile sector. Then in late 1980s, there was a bull market trend in textile industries. In 1992 to 1996, there was cement bull run. In 1997 to 2000, there was technology bull run. And after 2003, there were many sectors which has bull run, that is banking, infrastructure, real estate, capital goods, etc. So it is important for us to, if we want to find great investment opportunities, we have to first find the bull runs which are going to start, and then convert these bull runs into a great opportunity for investing. When investing in small cap stocks, the Vijay Kedia sir aimed to purchase at least 1% of the company. For very small companies, they were willing to invest up to 5% of the company. The allocation in the portfolio generally ranged from 5 to 10% based on an absolute amount perspective and the investor's ability to bear potential losses. So basically, small cap stocks are much uncertain, and it is there is uncertainty of whether they will perform good or not in future. So he had kept a limit to buy 5% of that company, and the range plays around 5 to 10%. When investing in illiquid stocks, he was mentally prepared to write off these investment completely, as such stocks can be challenging to sell or exit quickly. Let's understand the key learnings from his another investment, that is Tata Robinson Fraser Limited. Let me first give you overview of this company. Mr. Vijay Kedia sir has invested in Tata Robinson Fraser in 2001 to 2002. It is a company which provides equipments and services to the infrastructure sectors of the economy, such as steel, mining, power, ports, etc. It was available at cheap valuation at around 5 to 7 PE. He had bought a small quantity in 1999 to 2000 at rupees 40. It was a Tata Group company, and Tata Steel had shareholding in it. Despite the lack of interest and movement in the stock, he continued to hold on to it. In 2003 to 2004, when infrastructure boom started, the stock price rose to rupees 250, as interest in this stock has increased among investors, and increased his and he Vijay Kedia sir increased his position to 1% of the company. There were bullish reports suggesting that stock could reach to around rupees 10,000. However, the stock eventually peaked at rupees 2,200 before declining to rupees 1,100 in the 2007 to 2008 period due to negative news about the company. With the fading infrastructure boom, he began selling his shares at around rupees 1,100, gradually reducing his position. We can see in this chart that firstly he has bought stocks at around rupees 40, and then due to infrastructure boom, the stock price went to around 2,100 rupees in around 2007 to 2008 period. And after due to bad news circulated about that company, it has came down to around 1,100 rupees. So basically, the key learnings from this investment are: firstly, he has picked this company from cheap value at cheap valuation, which is around 5 to 7%, 5 to 7 PE, which also played a big role in making this investment successful. Second, he has learned from FII that selling has to be merciless. If one has to sell, it should not matter if the stock price is rupees 800 or 900. You have to stick to the process. or the thesis. Short-term profit or losses shouldn't matter. So basically, here he is saying that actually he has some attachment to this stock, and he has thought that it would move more than 2,100 rupees. But eventually, stock came down to rupees 1,100, where he had to sell the stock. So he is trying to say that one shouldn't get attached to a stock. If he sees that stock couldn't move further, he should sell there, and it doesn't matter whether it is around rupees 800 or 900. We shouldn't run for around short-term profit. If you want to sell, then you should sell and don't run for short-term profit or losses. Let's understand the key learnings from Vijay Kedia sir's another investment, which is Atul Auto. Vijay Kedia sir had invested in Atul Auto in 2005, a player in the three-wheeler market. At the time, the industry was only the industry only had 4 to 5 players with annual sales of around 4 lakh three-wheelers. Atul Auto was considered the weakest player and traded at a low PE ratio of 5 to 7. The industry was growing at 5 to 6%. It is basically available at cheap valuations. Despite being a weakest player, he saw potential in Atul Auto due to industry's incremental demand of around 20,000 vehicles annually. Atul Auto had a production capacity of 25,000 vehicles and manufactured 8,000, which indicated room for growth. There was no technological gap between the companies, but the real investment were in developing the distribution network. So basically, Atul Auto, basically three-wheeler industry incremental demand was around 20,000 vehicles annually, which is very big. But at Atul Auto's production capacity was also 25,000 vehicles, but it only manufactured 8,000, which is so we can say that Atul Auto was not using using its machines at maximum capacity. So there was a room for growth, and there was no technological gap between the companies. It states that Atul Auto was also up to date with the latest technology machines, but the real investments were in developing the distribution network. It is very important to develop the distribution network. A big company like we can say Asian Paints has also grown due to a distribution network. Atul Auto started growing faster, likely due to various factors coming together, including the investors' guidance and receptive promoter. However, in 2008, the company faced a setback when a new engine failed, resulting in the recall of 10,000 vehicles. He invested more money in company at that time through preferential allotment and became a director. Atul Auto also brought a new deputy MD from Piago, which was who was focused on growth. The company's turning point came with the development of a rear engine vehicle, and the rest is well-known story. So basically, it is this paragraph is explaining that Atul Auto started growing faster, and due to many factors like Vijay Kedia sir also played his role as an mentor to that company and to that management, and the company also had a promoter which which is focused on for growth of that company. But in 2008, the company faced a setback where a new engine failed, which resulted in 10,000 vehicles to which resulted the company to recall 10,000 vehicles, which is bad. So that was the time when Vijay Kedia sir has increased his share in that company and became a director. We can see that he has invested at around 180 rupees in that share around 2005, and the company's share price in 2014 had become 850, which is good. And this also became his one of his multi-baggers. We can study this fundamentals of this stock that is net sales, which became from 130 crores in 2006 to 493, around 500 crores in 2015. Its profit after tax has also grown from 4 to 41 from 2006 to 2015. Its debt to equity ratio also came down to 2007 to 2001. Its market cap has also grown very multiple times. That is 75 in 2006 to 1,219 in 2015, which is good. And market is has also valued this company highly. That is after the growth. That is in 2006 it is 18. PE is 18, and in 2015 it became 30.
Thank you so much, guys, for joining us in the part 4 of our masterclass series, where we explored the background of our Vijay Kedia sir and discussed a few captivating case studies. We hope you found it insightful and informative. In the upcoming part 5, Anuj and Aryan will lead you towards and giving the more insights about the investment process. Get ready for an exciting continuation of our exploration into the Vijay Kedia sir's investment wisdom.